Ladies and gentlemen of the crypto space, we're live on a Wednesday, July 12th at 11:39 a.m. As the title says, I watch flows, direction, capital creation, destruction to understand price action. Price up, price down. Sure, one that's meaningful from like a capital gains opportunity perspective, which is something that I don't entertain quite often unless it's obvious and a no-brainer and liquidity is just in excess and it's just best defined as up only mode. It's still important to understand directionality from what I talk about nowadays, which is comfort. I want to own things that will continue to exist into the future. I want to be able to withstand and be comfortable during periods of volatility. And clearly, we've had significant volatility throughout 2022 and 2023 thus far. But looking at the data that I look at, I'm like, all right, I understand why things are depreciating. I understand why things are going to eventually appreciate meaningfully. And I'm looking at data that is comforting that things will eventually appreciate meaningfully. There's plenty of volatility indicators that are all over the place, particularly capital destruction processes destroy liquidity, and capital creation processes like relatively high interest rates and cheaper collateral allows a better environment for offshore dollar printing, which is an increasing liquidity process, as well as especially the chart that I'm looking at most closely, which is the DXY. As the DXY comes down, that makes foreign fiat have more purchasing power. Therefore, there's relatively more liquidity for things that are dollar denominated. They can buy more. So ultimately, interest rates up, bond prices down, dollar down, and bond volatility muted is the ultimate condition for an increasing liquidity condition. So we have great conditions, and you take it day by day. We have our potential events all over the place, and clearly, like credit in the U.S. is tapped out, and bank accounts are tapped out. So what does that mean? That means that revenues and P&Es are going to be seen as too high. So price action is likely to come down, I would say, in equity indices. Albeit, what has the equity indices become? You got to think about the composition of these indices. The vast majority, 30-something percent, are the biggest corporations on the planet. So in many regards, if you look at equal weighted indices, it's been a catastrophe for the last year and a half as liquidity conditions have come down significantly. So putting it all together, there's one thing that brings me the most comfort, and it's the notion of flows. And it's what I know from my history in electrical engineering. And it's a simple equation. V equals IR. Voltage equals current times resistance. Therefore, the current flow, which can be thought of in terms of electricity or water for that matter, is the potential difference between 2 points. So if you have voltage 1, voltage 2, it's the difference between those two voltages divided by the resistance. So the flow of liquidity is proportional to the difference in two sources of liquidity. You have $1 trillion, you have $100 billion. So the difference between those two sources of liquidity divided by the resistance. So resistance can be thought of as friction. The amount of frictions in the system inhibit the flow of liquidity between two sources of liquidity. So if you have incredible regulation, burdensome underwriting procedures that take 3 months, 4 months, 6 months to get some credit, that's going to inhibit the capital creation process, but also the flow of liquidity. You have to create it first before it can flow from one place to another. So as the friction comes down, relative capacity for capital flow increases. Isn't that interesting, the simile in regard to, just standard electrical engineering and electrical circuitry? The same thing exists for fluid dynamics and potential energy, water at a height. So the potential for an amount of water to flow is the difference between uh, the heights of the waters, different potential energies. If there's more potential energy with 10,000 gallons of water at a particular height versus 5,000 gallons of water at another height. So the, the water flow between the two it could be comparable to delta in voltage, so to speak, to think in terms of these physical properties of real world phenomena. And the same thing applies to financials as we just discussed. Ultimately, everything in financials is a construct of humanity. Therefore, it's a manifestation of the same thing that the mathematics of engineering tries to achieve, just for a different purpose. And engineering is to understand the way things work, and the financials are basically a system of control, but that's another story. That's another story, ladies and gentlemen. Look at this chart. DXY punching through 10641. So this is in position for confirmation of continued depreciation from here. So it's cut through the 100 SMA, which is quite meaningful in the weekly, particularly in 2 days, 8 hours. If we get a nice close between the 100 SMA, sure, we can get the retrace back up for a support flip with a retest for support to flip resistance, and then you have to print the lower low for the trifecta of bearish confluence in this instance, and then you push towards the 200 SMA. The 200 EMA is somewhere in there. Yeah, the 200 EMA is right about there, at about 99. If you get to 99, that's going to have a significant impact on the composition of global liquidity. And that has a significant impact on flows through the systems of the planet. And capital will flow from underperformance to outperformance, and capital will flow where there is the least financial resistance, which is basically a process of regulatory and credit arbitrage. Now, if we zoom out, we see more interesting things, structurally. We see there's some meaningful support just below 100. You get to 100, 98, it's breached the threshold. There's meaningful support below it, and that really will be a test of political institutions, because all of this is a game of political arbitrage and them throwing around their weight and negotiations and truly just these sovereigns negotiating and playing games with one another. It's not a rigged system, but it's a system that is managed. And I've argued recently that it is quite a managed liquidity environment. If you zoom out to the 6 month, that is the most interesting from my perspective. And I just see the potential for a couple of years of increasing international liquidity conditions. Candles matter. We have confirmation of directionality, especially heading into 2024. We got to wait for the next 6 months and the close of 2023. So if this candle closes below, especially the close of the most previous candle, we could say that the most previous candle is confirming the directionality change following this shooting star, which is a very pronounced blow off top. Of a size the last we saw in 1985. And clearly we've seen relatively large shooting stars, a failed breakout above the TWAP back in 2009. But structurally, this is a blow-off top that was pushing toward a previous high in 2001. So, this is more of a blow-off top that threatened to break the previous high, producing a new higher high, which would be a very different structure to this chart. The geopolitical situation around the world, really would indicate to me that there probably is political will to try and force the dollar to not be as expensive relative to foreign fiat for purposes of survival. The U.S. is not in the business of collapsing the entire federation of actors that subscribe to the dollar regime. So, they raised rates and put all this pressure, especially from a dollar perspective. We had this massive rip from January of 21 to the blow off top and the end of 22. And that put enormous pressure on any country that is dependent on dollars for whatever their respective sovereign needs are. And that obviously pisses off the entire world. So why do we do that? We did that for domestic purposes, and that's something the Fed makes very clear why they do the actions they do. They design their policies to manage domestic requirements. But at some point, geopolitics must become part of the equation, and the hegemon must cater to its federation of actors. Otherwise, everyone abandons ship. I mean, look at the complexities going on with what BRICS is intent on doing. Now, the most important thing to understand with regard to BRICS is the time horizon, time frame involved in structural changes that everyone is like, oh, the dollar's dead and the gold standard's coming. The amount of debt in the system, the amount of dollars that are needed, you got to remember the most important thing to all sovereigns is social stability, social civility. Civility is financed. Why do you think there's all these social programs? Why do you think socialism is defined as what it is? It's the financing of civility, law and order. It needs to be financed. So there is no instantaneous collapse of a currency, especially the dollar. I mean, obviously there's relatively quick demises of other foreign fiat that don't have an external demand. Federation of actors that are constantly in demand of the currency. So why is there a demand for the dollar? One, for a couple of reasons. One, obviously commodities, and especially in 71 when oil for dollars came online. But two, and probably to a greater degree than even commodities at this point, is debt servicing requirements. The dollar's not going anywhere. And sure, they're going to introduce a new gold-backed currency. Fine, that's cool. We already have gold. We have tether gold, so we have a capacity to interact with a fungible, portable gold certificate of sorts. And we have plenty of other currencies around the planet. A new currency, okay, it doesn't change anything very quickly with regard to the structure of the system, especially with regard to flows. So for this chart, my expectation is dollar depreciation heading into 2025, maybe a 2-year time horizon in this regard. And we'll see what happens between 25 and 30. Reserves may be coming down with regard to U.S. treasuries around the world because of what the sanctions in Russia and everything they're pushing for. That structure is going to take I can't even see the time horizon right now for that to play out to a critical degree. Now it could gain traction, changes start at the margins, but they need to pick up momentum. So what is a time frame that probably rings in my mind as to check back for if momentum is building for that structural change of like different reserve currency and like overall the structure of financials around the world significantly changing to a critical degree? Check back in 2030. That sounds about somewhat of a decent time horizon of when to check if something structurally is starting to build momentum. So you can't get sucked into all the hype associated with there is no second best, or Bitcoin is going to be worth everything and no other currency is going to be worth nothing. These things don't work like that. And that's way too much hyperbole for my taste, and it's dangerous from an investing standpoint. It doesn't work, and it will be more destructive to one's own personal finances subscribing to that kind of ideology than productive or servicing what you're trying to do. The most important thing is to invalidate the fears associated with change. The reason people get sucked into that mentality of Bitcoin's going to be worth everything and every fiat's going to go to zero is because they are afraid that they will have no value, they will have no money, but they might not. Folks in aggregate don't really understand what money is and what we understand what value is. Value is something that someone else wants from us and they're willing to compensate us for it. So stable value, these are all very convoluted, murky topics riddled with emotional effects when people encounter them. The most important thing is to invalidate the emotions, especially emotions that incite you to think in shorter term time frames. None of this shit occurs in shorter term time frames. Even the liquidity that I'm looking at. I'm looking at liquidity and I'm like, and I'm telling folks that the DXY is breaking down. Oh, the dollar is crashing. Okay, so check back at 2024. Give it 6 months to really build some momentum and allow the structural change in the system to play out. We could have a very nice run in 2024. We could have very nice moderate runs heading into 2024. We got plenty of volatility events, capital destruction events, commercial real estate, the restarting of student loans. I mean, there's a reason why the current administration is trying to push off the restarting of student loan payments. Come on. That's going to dry up a huge amount of liquidity, a huge amount of buy pressure. CPI will fall through the floor. There goes earnings on corporations, and they don't want that. What they want to do is allow credit to tighten a little bit further. I mean, doesn't it appear it kind of stalled? So I don't really understand entirely the game plan, but they have thousands of PhD economists that think they understand the way those systems interact with one another, and that's incredible. And frankly, I do think they're smarter than we give them credit for. But their capacity to know the way all these knock-on effects play out, I find that to be extraordinarily unthinkable. There's no way you could, maybe with significant computing power, but the ripple effects of these changes and knock-on effects of changes in liquidity and credit creation are just enormous because there's so many components in the system. That's kind of really why they wanted CBDCs, because then all these flows through the system, all this potential energy, little pools of liquidity, your bank deposit, become data points. And these data points then can be managed quantitatively vis-a-vis software and AI algorithms to speculate on where the flows will go. This is all about flows. Your portfolio is about flows. Managing a financial system is all about understanding flows. That's all they do at the Fed, is contemplate, speculate, probably apply some sort of prediction algorithm and probabilities to potential flows and the ripple effects that those flows have on the system. HDIS in the house, lots of interesting things happening in the markets. Yes, indeed. Can you pretend that your IQ is a little lower so perhaps your communication simplifies for the common man? Ask a question. Everything I have ever tried to do is to get people to ask questions. The more questions you ask, I am forced to respond to the question. And then that'll give you a little bit more insight, and then you ask another question. The more questions you guys ask, the better you will be able to extract useful information from the things that I talk about. But otherwise, if you need to watch the stuff that I just said, this stream, it's really important. Like, this is like Mike Howell stuff and Raoul Powell stuff and Luke Groman stuff. Even Brent Johnson, I talked about bricks for a bit. And just so you got to ask questions, and that's the only way to digest this complicated material. Hope that helps, and feel free to ask anything, and I'm happy to respond. I'll get to every single question before I end the stream. I always do. Tapsy, yo, Sir Joe present. Watching since 2001, my IQ went up over time, so give it time. Indeed, this is all on a journey. I did not talk like this in 2021. The few folks that are still around, like Tapsy says, since 2021, was very different conversations back then. And there's a very different way I attack markets nowadays. Things have changed significantly. So even I'm still on quite the journey of finding comfort navigating this volatility and tapping into these flows of liquidity and processing the real reasonable time horizons involved in the the cycles of these markets. Look at the cycles of these markets. This is such a wonderful chart. Imagine you're in 2008. It's been a bull market for the dollar since 2008. That's 15 years. 15 years of a dollar bull market. And look, we cyclically had lows and then a high. And we just had a very big high. It happened to take 15 years. Back here in 1995, it wasn't until 2002. That was a 7 year. This is 15 years. This period of time is twice as long as a local low to a local high with regard to dollar currency compared to other foreign fiat. At some point, what goes up comes down. What goes down comes up. It's what everyone wants to occur with Bitcoin. And you zoom out, and obviously in a log chart, you realize the dips aren't the bear markets, the bleeding, the depreciation isn't really depreciation. So the log chart is maybe misleading, or maybe it's really peering through and seeing something informative that ultimately, if you held, you did very well, and you didn't really have to do much. But what you had to do is say to yourself, what I say is finding your comfort. And if you found your comfort back in 2012, you didn't have to do anything since 2012. You bought $5,000 worth of Bitcoin in 2010 to 2012. You did nothing. Look at us sitting here trying to understand how markets work so we can manage a structured portfolio. And all you had to do was literally press the buy button one time and do nothing after that. And that required comfort or just blissful ignorance. One of the two. Raul, John, yeah, well, not necessarily liars. They tell a story, and that story, you got to remember, is to cater to the average person. And you on this stream are not the average person. Anyone that could possibly listen to me is not the average person. Few people find me. The average person works, 9 to 5 at retail. Let's say a Walmart employee that has $100 in their bank account, paycheck to paycheck, never saves anything, probably doesn't own a home, rents, and is not heading in any reasonable financial direction. So that's who they cater to. And you can't talk like me to the general public. Look, Eric, it's a lot for Eric, and you're here. So to the general public, I'm speaking German. There's no words that can be understood. So you got to remember, they're telling a story, and the story is what? The story is to achieve social stability. And what does Congress do? They finance social stability. They finance civility. That's the equation. And once you realize why they do what they do, you're like, oh, and then you see the stories and you're like, oh, that's why they're telling this story. M. Nava, if the SEC declares Ether security, will you speculate what effects that could have on liquidity for platforms such as CRV? It would do nothing. That's only the United States. The United States is only a fraction of the global liquidity. In fact, the vast majority of dollar liabilities on the planet are not in the United States. The vast majority of financial activity is outside of the United States. So the United States is a small drop in the bucket with regard to global finance. It's a big part. We're the biggest consumer on the planet per capita, per person. But we're only a small part of global finance. So I'm much more interested in what's going on in Europe, Southeast Asia, and even like a Hong Kong. So, that's an interesting way to think what's going on in China, because Hong Kong's like a way for China to dabble with and express contrarian methodology, because obviously for mainland it's totalitarian, but they kind of pulled Hong Kong back in a meaningful way, but it's not still mainland, it's still Hong Kong. So it's kind of interesting what's going on out there, and I still hold true the Cosmos narrative being an East favoring network. And if you haven't noticed, Cosmos and Polkadot are making some waves, and it's just the BSN is still there, and this is going to be very interesting. The time horizon is what's critical. Time horizon to see what happens. Check back in 2030 with regard to blockchains in the East and what Cosmos and Polkadot become. They're going to become something, and I don't see it right now, but I see like a shadow. It's like when you're playing with Midjourney and you see the vague picture at 0%, and it takes a while till you start to see what the hell it's making. So we're like, 15% right now. So you get a brief little shadow of what the hell's playing out. Check back in 2030 for a lot of projects. Um, Raul, a lot of people, including you, are saying liquidity globally is increasing, yet everything in the world regarding financials indicate the most anticipated recession ever. Recession is separate from liquidity. Recession implies earnings, which means tax receipts are down, GDP is down, revenue for corporation is down. Great, recession. What does that have to do with liquidity? Now, destruction, like if a corporation doesn't have enough revenue and they go bankrupt because they can't finance operations, that's another story. That's a capital destruction process. It's also a shock. It's a liquidity shock because now capital's like, what the fuck do I do? So there's a lot of liquidity flowing around, so it causes anxiety. But recession in the U.S., there's a large planet out there, and this what we focus on, these markets that we're not staring at the moment, but like a Bitcoin, Ethereum, and a Curve. This is not a U.S. market. This is a global market with the resistance, the denominator I talked about relative to voltage. The friction to engage with this market does not go through the United States, who could directly engage with this market in any country on the planet with an internet connection. The frictions aren't there. You do not need licenses and registrations and a brokerage account at a Fidelity, which means if you're in Britain and you want to engage with Fidelity, you need the account. You don't need that with these markets. This is a global market, and therefore the resistance, the friction to engage with these markets is entirely different. Do you think everything will be covered by the most brutal money printing in history? Well, everything. Thus far, they've bailed out 4 banks, but they bailed it out in a light touch approach. They didn't significantly change the liquidity for the general public. I don't think they'll have to do that. I don't see that on the time in any time horizon. But bear in mind, us individually, we have our own liquidity conditions, and just like corporations, our individual bank account is our available liquidity. So I don't see capital destruction coming right now. And they literally said for the banks to be favorable with regard to commercial real estate and that coming complexity. I think it'll be smoothed over, and that's not with regard to printing. You don't want to see printing. You don't want to see a destabilization of liquidity. You want to see them well manage the financial system, a managed liquidity environment. You don't want to see delta liquidity up because that just throws everything out of whack. You don't want to see the biggest money printing ever. You don't want to see that. I mean, bear in mind, they did print $1 trillion worth of collateral, which is short-term deflationary because it's removing that $1 trillion from circulating supply. But then that fills the TGA, which the TGA then spends into the economy. So that currency is now additive to the collateral that is now in circulation. And that collateral, when used outside of the United States, is used for offshore dollar printing. So ultimately, after a little bit of time, the issuance of more national debt increases the global currency supply, which is the global overall liquidity situation. So I don't don't want to see brutal monetary money printing. I want to see a managed financial system. And what will happen is capital flows from underperforming to outperforming. Capital flows from a highly regulated environment to a less regulated environment. Capital flows from a highly friction-filled environment to a less friction-filled environment. Uh, Seeking of credit flows from a process burden environment to a permissionless environment. So what I want to see, Raul, is a stable system. And you don't need to see some sort of perverted money printing. You just need to see the system exist and remain and be functional. And in time, capital will flow here because of what it offers. Eric, my man, I'm happy to help. Ask any questions. Good afternoon. Dan, a pleasure. Companies laying off people, higher rates, banks exploding, war, commercial real estate. Sure, when the capital destruction occurs, we'll assess the reality. In that regard, we have M2 up on the board. We have the Fed balance sheet, which is just screaming increasing liquidity conditions. You have the dollar, which means there's increasing liquidity conditions outside of the U.S. Bear in mind, you just primarily talked about U.S. conditions. $100 billion from, Southeast Asia or some country in Europe flows into DeFi, you're not going to give a shit about what's going on in the U.S. What you're going to care about is the balance sheet of your local supermarket. For me, it's Publix in Florida. You want them to be solvent and remain functional, so you care about the enterprise actually being there, because if there's no enterprise, you making a boatload of money, it doesn't matter that you have money if there's nothing on the supermarket shelves. So that's another story. I understand platforms like GMX and Rollbit aren't of interest from an investment standpoint to you, but how do you feel about their general longevity potential? High likelihood to continue to exist and thrive. Gambling dates back to the history of humanity. They are perp exchanges, and they're novel in regards, so it's a big deal. Um, the period. I mean, look what Arthur Hayes does with GMX. Bottom line is, he that's what his go-to is. His go-to is his trading, and that's what he likes, and that's cool. But bear in mind, it all reduces to the common denominator of APR. Corporation provides cash flow. What is the likelihood for that cash flow to continue to exist into the future? And what is the potential for that cash flow to increase into the future? So if you're getting 20% APR on $10,000 worth of an asset, and that asset becomes $10 million and it goes to 1,000% APR, it's going to dilute, and that's what drove up the price. So you'll end up getting the 20% instead of the 10,000% on the higher valued portfolio. So overall, my expectation is a lot of appreciation coupled with a lot of dilution. But since a lot of the cash flow is not denominated in dollars, we are likely to see the APRs briefly go through the roof, somewhat proportional to appreciation. But then that'll get diluted. If you see that counterbalance effect that is likely to play out. Secondly, do you believe that over time more and more people will use DEX over SEX? Well, I don't know. That's a good question. Decentralized exchanges are opt out of the system. It's what Arthur talks about. Outside money, get out of the system, and bearer instruments, and the whole, that narrative. And that's a big deal. It's not about the majority. There's plenty of capital to be made even at the margins. So from a societal structural standpoint, clearly the vast majority will use corporate infrastructure and centralized exchanges. The vast majority of people have no capacity to manage their own assets, the custody of their own assets. So I don't have any fears that both will grow, and I don't have a real sense of which will grow more. but there's very much a significance to both sets of infrastructure. Eric, too bad Polka, Dex, bands, USA, IPs. Yeah, but you use it from like England or Sweden, Switzerland. You don't have to access it from the United States. You just access it from another country. And that's what's so meaningful about these systems. And bear in mind, that's also just the user interface. The more interesting DeFi protocols have alternative user interfaces. What comes to mind that has done that quite well over the years, that's Liquidity. They have plenty of alternative user interfaces. And frankly, all the DEX aggregators, I mean, they're all sourcing like Uniswap and Curve liquidity. So, Uniswap has a capacity to censor from its user interface, but the contracts are uncensorable. So if you're on, Paraswap or 1inch, you're still accessing LP pairs that may not be accessible on the Uniswap user interface. So just pick a different country. That's this kind of world, and that's what politicians are not really digesting. What country? If you do regulation in the U.S., just use it from another country. So it's like that would be equivalent to if you're accessing a user interface from another country, that's equivalent to buying Swiss francs and interacting from Switzerland, like having a Swiss account. They would actually have to have regulation banning international investment. I mean, that's probably the thought that's pertinent in that regard. So just from another country, a country that has more favorable regulations. And now you're talking about regulatory arbitrage. Brian, afternoon, Captain. Pleasure. Create your shape. How do you know you will be able to withdraw your gains going into the future? With withdraw gains from where? As into a bank account? As into a debit card? There's things that I have been interested in looking into, getting international debit cards, prepaid debit cards. And, there's permissionless debit cards that have limits, like $1,000 limit, which needs no KYC and no validation. I forget the protocol. Maybe I still have it open? No. Yeah, Mount Perlin. There's no KYC on this thing for like $1,000. Well, this is to a bank account. Well, there, look. Maybe they have a debit card product. No, they have no debit card. So, but oh, I don't have it on the screen. So Mount Pelerin. So, but there's no KYC under a certain amount of capital. It's from Switzerland, apparently. So there's plenty of systems that allow you to convert from one currency to another. And sure, we could fear the capacity for regulation to create friction with regard to our interest to move capital from one market to another. But ultimately, listen, I think there's too much benefit. I recently had experiences with commercial banks in the United States locking me out of a bank account for like 2 years, and I had to get the courts involved, and it was a very friction-filled, relatively frustrating experience. So what happens if you had to leave the country? Like think of you're afraid of unable to withdraw your capital, but what about some crazy circumstance? Everyone is up there thinking up in the thread talking about recession and potential war and crazy shit. What if you had to leave your house and walk across a border with a backpack and maybe one suitcase if you're lucky, and you can't get your money out of a bank account? So what if you can't withdraw your capital? What if you can't withdraw your capital from a bank account and you really need to? So a good part of my mentality, two things. One, it's not emotional. Two, it's prepared for scenarios. The better you're prepared for scenarios, the more comfortable you will be. So think about that. If you needed to walk across a border, can you do it quickly? Can you do it the same day? That's meaningful. That's powerful. Are you keeping up with what Circle is building regarding their L2? Very interesting. Keep me posted on that. I'm out of the loop as well. Pardon the pun. My man. But that's big stuff. Come on, what Frax is building, that's big stuff. Frax chain using FRX ETH as the native Ethereum, that's crazy. Time horizon. Check back in 2024, and I just think 2024 heading into 2025, we have the market screaming increasing liquidity conditions, and outside the U.S. Increasing liquidity conditions outside the U.S. Domestically, inside the U.S., we have indication that there's going to be decreasing liquidity conditions. Credit is contracting significantly. There's a potential for for revenues, for earnings of corporations to significantly decrease, which means there's potential for depreciation of U.S. equities. That's the U.S. I'm not too interested in U.S. liquidity conditions, separate only in as much as it contributes to the overall liquidity conditions of the planet. In that regard, look at global M2. Look at M2 of the U.S. Plus the ECB, plus Japan, plus China. I don't know. Throw in a couple of what other big M2s are there out there? Raul talks about the G5, expanded to the G7. There's a lot of liquidity out there, and the U.S. is looked at too often as the center of everything that's important with regard to financial data. I am much more interested nowadays in international conditions. Hope that helps, ladies and gentlemen. I appreciate all of you. 28 people in the stream, 12 likes. Hit that thumbs up button. We can do a little bit better. Wednesday, July 12th at 12:20 p.m. Tell everyone to subscribe. I'm happy to continue this conversation on Discord. We got plenty of channels to talk about this stuff on, and I'm always around. So I wish you all the best. After parties on Discord for the most rational community in the entire crypto space. I wish you all a good day. I will see you again on Friday.